Hi, everyone. This is Yuman from Turn Zero. I will start the session in about half a minute, just as people log on. We will start today's session, 2022 SaaS Retention Benchmarks. So hold on for just about 30 more seconds and we'll get started. How are you doing today, Rob?
I'm doing great. Excited about this. It's gonna be fun.
Yeah, it's gonna be a good one. How many years has it been since you?
I was just thinking about that. So part of my slide is this is our 11th survey.
11th year.
But we've been doing it together for 4 years.
Yes,
so almost half the time.
That's right. We've been together for years. Yeah. It's always a great conversation. Looking forward to today.
I was also thinking about it. We're so well aligned too, because I was thinking about like we both have named our companies what we do, right? We're all about the SaaS model, right? We provide capital to SaaS companies. You want churn to be down to 0.
That's right. Yeah, you know what? I would say we can have a naming webinar at some point and see like how good that is. And some, it doesn't always work, but when it does work, it's very interesting.
Yeah.
All right. Well, hey, Rob, let's get started. Well, hey, everyone. Good afternoon, and thanks for joining us today. My name is Yuman Sang, and I'm the CEO and co-founder of Turn Zero, and we make a customer success platform. And I'd like to welcome you to our webinar today. It's titled 2022 SaaS Retention Benchmarks. How does your company compare? Now, before we get started, I'd like to remind you that we are recording the session, and a link to the recording will be available to you tomorrow afternoon. Now, throughout the presentation, please submit your questions. Oftentimes we get a ton of questions for this webinar. I expect today to be no different. Use the Q&A button, please. I won't be using the chat at all. So the Q&A button, go ahead and submit your questions. Now, I'm really pleased to introduce to you, and you may have heard him already, our guest today is Rob Belcher. Rob is the Managing Director of SaaS Capital, and they're the leading provider of growth debt designed explicitly for B2B SaaS companies. SaaS Capital was the first to offer lending alternatives to SaaS businesses based on their future recurring revenue. And really, you've launched a huge industry. I mean, it's this is a real alternative to SaaS companies, and given SaaS companies real flexibility and sort of how they can grow and capital that they can use to fund that growth. This is our 4th year partnering together on this retention benchmarking webinar. And I'm looking forward to digging into this year's survey data. All right, so let's get into it. What you see is the agenda, and I'm going to go ahead and pass it over to Rob, and Rob can talk a bit about the metrics, and then I will chime in just to color commentate a little bit. All right, Rob.
That's great. Yeah, thanks, Yuman. Like we were saying at the intro here, great to do that. This is always an awesome conversation. You all, Turn Zero knows the CS industry cold. It's an important part of what we do. We lend money to companies based on their MRR. And so retaining that MRR so that you can pay us back at the end of the day is a key part of our underwriting. And as part of that, we want to be able to benchmark both prospects, anybody we're talking to, and our own portfolio companies. And so, like we said, 11 years ago, we started a survey, just almost more self-serving, just interested in kind of where and that was sort of mid early stage of the SaaS industry, where metrics were kind of all over the place. Wanted to understand where the industry and the metrics were. Fast forward to today, routinely get 1,500 plus companies respond. It's all B2B, and we kind of, that's what we focus on. So this, again, it's a little self-serving because that's what we focus on. That's who we lend to, and so that's the data we want, right? And so it's focused there. Apologies if you're a little tangential, but that's our focus. But we do get companies anywhere from pre-revenue to hundreds of millions of ARR, ACV, the whole gamut from hundreds to millions. And then geographically, because we're focused mostly on the US, UK, and Canada, that's where most companies are, but it is global. Increasingly seeing more and more SaaS companies in South America and Europe and Asia. And the focus, we try and keep the survey, probably a fair number of you have taken it, so you're familiar. We try and be detailed and get some great metrics so we can do things like this event and some research pieces and blog posts and things like that. But at the same time, try and not take up a day worth of munging numbers for you. So it's about 20 questions, and only a few of those are on retention. So we focus on revenue retention, both, again, because we lend off of revenue. That's a key focus of ours, as well as revenue is sort of both the blood and the air, right? The oxygen for a SaaS business. And so while a CS group or an individual CSM might focus on certain other areas or metrics or cohorts, at sort of the CRO, CEO, advisor, investor level, head of CS level, we think revenue is the most important. Be curious your thoughts, Yuman, too. But we focus on those. And so we've asked the two metrics we ask for in the survey are net and gross revenue retention. Here's the formula for how we ask our borrowers both to report it. And we usually even have a covenant on retention. And this is the formula. It's an annual year-over-year monthly cohort analysis. And it's what is the revenue that you generated in December of 2021 from customers who were customers in December 20 divided by your total revenue in December 20. That includes upsells, cross-sells, price increases, if maybe you might want to increase your prices for inflation or anything like that as an idea. And then for gross retention, it's the same. I don't have it listed, but it's the same formula, but you obviously don't include cross-sells, upsells, price increases. The best you can do there is 100%, just keeping all that same revenue. Any thoughts there, Yuman?
Yeah, I mean, like you said, revenue is most important. I could not agree with you more. And I think, maybe we used to debate it. In fact, I think our first webinar, we were defining every term. Yep. Like every term we were defining, and I think we don't have to do that anymore. Now people just want to know, like, okay, like what's the latest? Are we in line, and how do we get more sophisticated? So I think people are really aligned on revenue, and then the sophistication has really gone up. So that's what we're saying.
That's one of my big takeaways for today. Actually, is I think the sophistication and the table stakes have really been set, and more folks are deep into CS earlier and often. So we'll see that in the data. My only other comment on metrics are we're starting to see more people report percent of revenue retained that was up for renewal that period, which is a pretty interesting one. It's great to track. It is more volatile because, like, obviously you might have a month where you only have $10,000 up for renewal versus 10 million up for renewal, right? So the numbers are all over the place, but it's an interesting one to keep an eye on too. All right, let's jump in. This is my first chart. This is our standard. We like to spread retention by ACV. We think more than any other way to look at companies on a retention basis, annual contract value is the best. Companies that share a contract value more than anything else will probably be organized the same, have similar go-to-market strategies, similar sales team, organization, comp, CS team, all that stuff. So we like to start off with an ACV analysis, and you can see the median net retention, the median gross retention here on this chart by ACV. The cross-survey medians were 102 this year for net and 91 for gross, which is actually up a little bit from years past. So a couple things there. One is, these are my two big takeaways. You'll hear me say this multiple times. One is 2021. Oh, I'll back up quickly. One data point about the survey. We run it in January and February of each year, and it's based on the previous year's performance. So as companies are closing their books in December, we run the survey and they can report on them in January, February. We just finished the survey up in March, and this is one of the first research pieces. So all of this data is on calendar year 2021, ending in December. So you'll hear me reference 2021 a lot, even though we're already in June here. And so 2021 was a bull year. Back to this slide, was a big bull year, right? We all lived through it. It was a very hot year, and so that might play in a little bit on the higher retention rates than normal. We have historically seen 100 for net and 90 for gross, and that might not sound like a huge increase, but keep in mind this is 15. This is the median. And there's 1,500 companies in the survey. And so bumping up a couple percentage points on the median is actually kind of meaningful. And then my second one, which is also my second big takeaway for the data, which is sophistication, table stakes, monitoring, measurement, is I'm loving to see the medians move away from the big round numbers. Yuman, you and I have talked about this for years, like 90 and 100, really? Like, and I think there's some like, it feels like 100, so people enter in 100, right? And so to see that median move to a specific number, I think shows a sophistication in the data set, which is great. My second comment here is that there's a clear, on the net retention side, clear increase in net retention at about 25K of ACV, which makes a lot of sense. The contract value bumps up into a range where it makes sense to have a dedicated CSM working with clients. There's probably a more formal sales and implementation process, just a lot more opportunities to further the relationship and upsell, cross-sell, all that stuff. On the gross retention side, a pretty steady and linear increase in gross retention as ACV increases, which also makes sense. But actually, let me finish with net retention first, because it'll make more sense on the growth side. There's that bump to about 105, 106 at 25K of ACV. But beyond that, what's interesting is there's no like continued relationship between ACV and net retention. And I'm thinking that that's because you get to this point where you have dedicated CSMs, a true sales process, implementation, all that stuff, QBRs, whatever it may be. But beyond that, whether your ability to upsell and cross-sell is completely idiosyncratic to your business, your market, your product. And so some will be very successful, others there's limited opportunity there. On the gross retention side, the story that makes sense to me here, and curious, Yuman, if you agree or disagree, is on, gross, just the bigger the contract, probably the longer the contracts, the more implementation, more people, more touches with the customer, all that. And so you have this sort of pretty steady linear relationship between the two.
Yeah, I think that's right. I mean, I think the more you pay, the more skin you have in the game, and the more you're hoping for it to work. And oftentimes, the more you pay, the longer it takes to get running anyway, and that accounts for maybe multi-year deals like you're talking about. The interesting thing, and I think your point, the difference between GRR and NRR often is also a go-to-market model, right? Some of the folks with the highest NRR in the space that you hear about, like the Slacks of the world and the Atlassians of the world, they have very low ACVs to begin with, right? And so they have a lot more upselling to do. In fact, they almost have to. That's their model. The model is like get in really small and then upsell. And so those are the folks with sort of really like crazy high NRR. And one of the things I would probably make sure that everyone on this call knows is that, your NRR is not only a factor of your ACV, but it's also a factor of your go-to-market, right? So like Slack better have a great NRR because they start with one team, right?
Or one person. Yeah.
Or one person, like one person buys is $25, you better have a huge ARR. But if you're, selling a big platform, like an HR platform where everybody has to go on once, like it's, you're selling a pretty big thing up front, and your NRR may be, you just may not have as much room. So, but this generally makes sense to me. But I think the difference between NRR can often be go-to-market as well.
So this is something we've been doing more of, moving on to this slide, is looking at quartiles. So medians are great. Oh, and also a couple of comments on the data. One is we tend not to do averages. We do sometimes, but averages get blown out with, really high, somebody enters in a very high number, whether it's real or not, and it blows out the averages. So medians are a nice way to trim the data. We also, you'll see this little caveat, we tend to, for that same reason, exclude companies with less than $1 million of ARR, just because their denominator is so small when calculating things like growth rates. So we often look at sort of more established, more stable, and bigger companies tend to have more stable, longer track record of their metrics too. So just to comment on the data there. But so on that point, here, the blue boxes here are our median from our previous slide. And then we've been looking more at quartiles as a way to understand outliers, because we think outliers are really interesting in the SaaS world. So this is net retention, again, by ACV. And this will be contrasted with the next slide, which is on gross retention. Here, we'll stick with net retention for just a second, but we'll contrast it. Kind of good to get a preview there. And that was great. The bottom band, the 25th percentile, is actually pretty narrow and pretty tight with the median. And I find that to be really interesting across all ACVs, a little bit more spread down with the smallest ACV. But then obviously the 75th percentile is where you get the broader variance. And the really interesting one for me is the step between 50 and 250K of ACV, where this 100K, 150K, 200K sweet spot, I'm calling it a sweet spot, I don't know, something to keep an eye on in the future, is there seems to be more opportunity for upside, even compared to bigger companies. So back to your point you're just making, Yuman, is I wonder if, like, for really big products, really big ACVs, it's probably like a 5-year contract. It's got a lot of consulting built around it. It's probably a fixed price contract. It's not based on seats or anything. So there's less room to actually upsell that customer than something that's sort of in this really nice range where it's a big product. It's probably 1 or 3 years. Maybe there's some built-in escalators. Maybe, there's some products and features you can bolt on to the side, more seats. I don't know. That's just a thought, but I think that's really an interesting thing to keep an eye on, that dip in the 75th percentile for the largest.
Yeah, I think a lot of companies are sort of, what is my sweet spot for, for selling, and how do I sell, and how do I get in quickly, shorten the sales cycle, and so maybe that pushes the smaller companies to get in first and sell more later. So yeah, it's very interesting.
So then, if we look at the next slide, is gross retention, and it's flipped, which makes sense. Gross retention is capped at 100. You can't do any better than just retain all the dollars you had the year before, and so seeing the 75th percentile sort of hitting that upper bound makes sense. But this bottom bound here, this is where gross retention is more, on the downside risk, rather than net retention is what are you leaving on the table on the upside. Net retention, and we see it here in the data, is particularly for the smaller ACVs that are maybe more like growth led, right? There's no salespeople, it's self-service, higher retention. You better have that really high net retention. And I think you talk about the spread between gross and net later on here, which is going to be really interesting. But then very linear, the larger ACV products have really solid gross retention, even at the lowest quartile here.
Yeah, I don't have anything to add to this.
That's okay. Yeah, it's fine. Great. So the next one is actually sharing retention rates by ARR. This is sort of a proxy for company age. Mm-hmm. It's definitely company size, but also we can kind of see the life cycle of retention over time. We just published a paper that this all comes from, and we actually break it by actual age and by ARR, and they're pretty similar. So I just did one slide here. But the story to me is, historically, net retention was actually pretty flat across all company sizes. And it's pretty interesting to see net retention scale with companies here as they grow. And I think that comes back to my one big takeaway is bull year, rising tide, all boats, customers were buying more, deepening relationships, just growing heads up, heads down. And so that's part of it. But then also my second big takeaway, which is, I think this kind of also shows that companies have embraced over the last 3 or 4 years CS earlier and often, and are reaping those rewards with higher net retention. And we're going to see this in another slide or two here. The dividends of that and that compounding nature of it as they get to sort of double digits of ARR. My last comment on this slide is a really interesting one we've seen in the past. It's subtle, it's slight here on the gross retention side. It's only a couple percentage points, but it's meaningful, it's interesting, and we've seen it year over year. Is a little bit of an overstatement in gross retention early on. Mm-hmm. And we think that's because customers haven't had a chance to churn out yet. A company is relatively small, they're relatively early, they sign 1 or 3 year deals. It isn't for 3 more years before that customer has even an opportunity to churn. So it is not unusual to see gross retention dip as a company grows, both in age and in ARR. And then, you get sort of 5, 6, 7, 10 years in, 7, 8, $10 million of ARR. You figure it out. Maybe you've ignored an industry, you're intentionally turning away an industry that you started with that you don't want to serve anymore. You found your perfect product market fit, and away you go, and you start to increase your gross retention. So that curve is not always be aware of decreasing retention, but as a executive or an investor or an advisor, not unusual to see this sort of life cycle of gross retention over time.
Yeah, the thing that stood out to me, Rob, about this particular chart is, basically the difference between the blue and the green, right? Between net revenue retention and gross retention, and that distance is getting bigger the bigger you are. Mm-hmm. Now that makes a lot of sense to me, right? And so when you're smaller, you're just selling what you got. You probably just built something that's pretty new. By the time you're more than $20 million, you probably have a second product to sell. Maybe you have an add-on. Maybe you've have additions, right? And so people are buying different types of additions that you can upsell them on. So, it makes a lot of this actually, kind of confirms a lot of suspicion. It's like, hey, the more sophisticated at least the bigger you are, you really want to start investing in growth. And so when you're at $20 million, there's a 15% difference between gross and net. And that's actually kind of I think that's probably as big as I would like to see a healthy company, although some companies are really, really big. We'll talk about that a little bit, but
Yeah.
it's good. It's good to see that.
It's really, yeah, that spread we've tried to look at in the past. It's a little noisy in the data, but it's really an interesting, yeah, it'll be interesting to talk about that in a minute here. Two other ways to slice and dice this data for you before we get to my last slide is on target market. And would love to have data. And I know lots of people want to know like their exact industry that they serve. Too hard to do in a 20 question survey. The best we can do is vertical versus horizontal. So vertical is self-identified. Do you serve a vertical industry such as like, sell only to dentists or only to shoe manufacturers, right? Versus horizontal is more like marketing automation software for mid-market or, accounting software for SMBs. So that's the spread here, the split rather. And you can see that they're actually relatively close this year. And this goes back to my first point, which is everybody did pretty well in 2021. Historically, and particularly in 2020, vertical focused companies had much higher retention than horizontal companies. This year, that completely wiped out on the net retention side and a pretty close discount on the growth side. It's so, not as much of an impact, whereas vertical were really able to support their customer base during the pandemic. Horizontal were more at the whim. You might have some hospitality and travel companies, they're going to churn, nothing you can really do. So that's kind of what we saw the year before. The other chart here is on funding type. So this is on bootstrap companies versus venture-backed companies. And this one is really interesting. And this goes to my second point, which is table stakes on customer success, best practices, team building, growth, all of that. Historically, VC-backed companies had higher retention, both net and gross, than bootstrap companies. Full stop, pretty significant. Not much more to talk about. The story historically is that your VCs are probably former SaaS execs who have been through it, have playbooks, have 5 to 15 other SaaS companies they're working with, lots of shared experiences that they can plug into your business and help you focus on and grow. Whereas bootstrap companies didn't have those resources, maybe even didn't know that CS existed. They were just sort of supporting customers, whatever. That seems to be wiped out. There might be a little bit of the rising tide all boats happening here too, but certainly, and we've been seeing it with prospects and with our portfolio, everyone's building CS teams and focused on upsells and cross sells and things. So it's really interesting to see the historical relationship is actually flipped on gross retention here. Still a little bit of a difference on the net side.
Yeah, actually, I find that fascinating. And so your point is that bootstrap companies are learning best practices and have caught up to venture businesses. So the difference in retention metrics, at some point you would think, venture-backed companies have such a growth mentality, right? That they're, maybe pushing bad fit customers, trying to grow too fast. But, imagine over-investing in that will have more of an impact on new sales rather than retention, right? So, okay.
Yeah, and I think, remote work, more blog posts, more podcasts, more webinars like this, more software solutions. There's just more available to bootstrap companies now than ever before. So there's just more resources when historically, 8 years ago, it was harder to find, right? So, okay, my last chart here is really cool. This one is fun. This is a new one this year. We spread growth rate by net retention buckets. So we took the companies and we split them into 10 percentage point buckets on net retention, below 90, 90 to 10, et cetera. And then we took the median growth rate for all of those. And something really interesting jumped out at me. So first off, if we split it at 100% net retention rate, right, the bottom two columns, negative to no difference between the two. And that makes sense. We have the leaky bucket phenomenon going on. These companies they're not even making up their churn with upsells and cross sells, right? They're actually negative churn, positive churn, negative retention. So they've got to fill the bucket to get to 100, and then they've got to grow. So not surprising that growth rate is 29, 27%. Median growth rate across the sample, by the way, is 40%. So they're below the median, and kind of no difference between the two. What's really interesting is what happens at 100%. When you get the flywheel and you get the bucket is more full this year, and then you add on new bookings, growth rate grows at an increasing rate for every 10 percentage points of net retention here, right? As you bump up from 110 to 120, your net retention goes up by 7%. And then it goes up by 13, right? And so it increases. We have this exponential, which makes sense. It's compounding, and that's the whole power of the net retention. And just to see it here, it all is intuitive, but to see this here was really surprising and really interesting. My last comment is just data for you all. 40% was the median growth rate. That was also the growth rate in 2019. So again, kind of back to parity with pre-pandemic, if you will. That dropped to 29% in 2020. So back up from there. So that's my last slide.
Yeah, I mean, bottom line, if you want great growth, you need great retention, right? So yeah.
And this is, and you'll see, I mean, we're going to talk about valuations in a minute. This is directly related to that, right? Is net revenue retention drives growth, and growth rate drives your valuation significantly.
All right. Well, hey, thanks, Rob. Let's move into sort of a some strategies or tactics around the growth. So so Rob talked about where you ought to be. So put yourself in a place and think about, do you need to improve, or actually are you doing pretty well? We can do a webinar behind each of these slides. So I'm going to try to keep it very quick, and really it's just putting in your mind the things that you should be working on, and I won't step into it, right? So if your NRR or your GRR is not where you want it to be, right? I have 5 things for you to focus on. One is take a look at the customer experience. There are weak points. It's probably going to be onboarding. It's probably going to be adoption. Those are probably 2 things that, one is, where the typical SaaS companies, typically have holes, and also things that you have the most control of, right? So one, understand the weak points in your customer experience. It's probably onboarding, probably adoption. Go find those, fix those. Second, is to create and review your playbooks. If you have playbooks, that's fantastic. If you don't have them, create them. A well-functioning CS. There are things that happen, right, to every account, and a well-functioning CS team, they're not making it up every single time. So, for meaningful events, whether they're good or bad, create a playbook on, these are the things we'll do when these things happen. Failed onboarding, you got to do something to save that. 100% plus utilization, that's great. Maybe that's an upsell, and sell them more users when the champion leaves, when a company's acquired, right? So these are things, think about all the things that happen to your accounts at a regular basis that really have a meaningful effect, positive or negative, and then create a play around it so that your team can do, things in a scalable way. All right, let's get to the next slide. Hey, by the way, I'm sure if you have bad NRR, nobody's going to like it. Your board's not going to like it. Your CXOs would not like it. Ask for resources. This is a time for you to bug sales, bug product, bug engineering for resources. Okay, so this is sort of your opportunity to go and ask for something. Let's move on. Okay, and then this is, of course, also resources for yourself, technology, operations, people. What we're finding is that a typical well-functioning CS department is anywhere from 5 to 15% of all the costs in the company, right? So think about, all the costs in the company, everything, right? Sales, marketing, G&A, the customer function really should be spending about 5 to 15% of that is sort of what we see. So if you're spending sort of significantly less, or maybe in the low end in that, you have some room, right, to ask for more. And so use this opportunity to ask for more. And then, start selling. Okay, start selling. I think a lot of CS teams are not focused on selling, right? They're focused on making the customer happy. Of course, that's job 1. But job 2, especially if your NRR is low, is maybe for those customers that are very happy, making great use of your product or service, start selling more to them. And if you don't have anything to sell to them, maybe you design, sort of add-on products, services So, short term, you can use comp plan changes that often will work, right? Individuals react well to comp changes. And then long term, focus on like real differentiation, like product add-ons and product additions. So a couple of tips if your NRR is doing really well, right? So if you're doing really well, let's go to the next slide. You're strong. What should you do there? So continue to focus on pushing out best practices, right? So this is sort of where you feel like, okay, maybe I'm doing well. Continue to invest in operations enablement, right? Because those best practices that have gotten you there, make sure they're codified, make sure that they're pushed out within the organization. So push out those best practices. Now, let's move to the next slide. And then, oh, by the way, push the advantage into new sales. If your NRR is good, you probably have very happy customers that are, and customers really do want to help their vendors, right? Sort of naturally, people want to help you. So customer reference programs, customer referral programs, right? This helps new sales close business. So you push the advantage, out of CS into sales, help them close more. They will definitely appreciate it. There's nothing better for sales than a great customer referral and a great customer reference. All right, let's go to the, okay, mind the gap. Okay, so examine the gap between GRR and NRR, right? So, so basically net gross versus net. If your gap is anywhere from 5 to 15%, you probably want to get to about 15%. You probably want to get to 10 to 15%, right? So if it's kind of on the low end of that, focus on your expansion strategy, ways to get more, deliver more value and get more dollars from your customer. Now, if your gap is more than 15%, let's just say your gross is 85% and your net revenue retention is 110%, right? That's a 25% difference. You may actually, be asking a lot from your customers, so let's focus on saving a few more. Let's get that 85% GRR to 90%, right? Because you're really wringing the towel pretty dry.
And something that you're bumping into there is you're increasingly concentrating your larger customers, and a lot of investors are going to have customer concentration limits. So you want to be real careful there. It's great. You've got whoever it is, Walmart, right? And they're buying more and more of your stuff, and they're becoming a larger and larger percent of your revenue. It's great, you're growing, but at some point that tips the scale and now becomes a risk, right? For funding or acquisition.
Yeah, no doubt. And also, it does. Then you get into bad habits where you're really trying to. Then the selling becomes so important. It does become a bad habit. All right, let's move over to the valuation update.
Yeah. So all of that is related to your valuation, right? As we said earlier, growth rate and NRR drives growth rate drives valuation, all very important. For those of you who have followed us for a while, you might be familiar. We did a big white paper a number of years ago on methodology for valuing private B2B SaaS companies. And the magic number, if you follow us or remember, was 28%. The summation of that framework and that formula was you take the current public market and you apply a 28% discount to it, and that's your starting place for what a private B2B SaaS company would be worth. And then you apply some levers based on your own personal metrics for growth rate, retention rates, gross margin, things like that. And that's where this benchmarking comes in, right? Are you better or worse than your peers? And so you earn a premium or a discount. Well, that methodology broke during the pandemic when the public markets went kind of haywire, and it was stale anyway. We wanted to upgrade it, so we spent early part of this year, and we're just about to publish a new white paper coming out in a week or two with a new framework, new methodology. It's quite a bit more statistical and quite a bit more robust. The first framework was based around some of our data from our portfolio and their transactions compared to the public market at the time. The N was relatively small. The public markets was trading in a narrow band. It was pretty straightforward. Markets have gone crazy. We have over 50 transactions now, and so enter sort of more rigorous statistical modeling. The main tenets still hold, which is start with the public market. What is the public market's appetite to own SaaS equity? I like that expression, that way to think about it. What's the market? How much does the market want to buy SaaS companies or invest in SaaS companies? So that's the macro. And then again, apply sort of some levers for your company specific metrics around growth rate and NRR specifically. So we'll start with the public market. We built this something called the SaaS Capital Index. It's a index of 91 public SaaS companies. I think it was like 45 a couple of years ago, and then there was this rash of IPOs, some of which bumped up the market here, bumped up the median a little bit. So now it's up to 91 companies. These are all B2B, pretty pure play SaaS companies that mirror a type of company we might lend to. And so that's on purpose so that we can track this. Again, all of this is a little bit self-serving, so we can do all this analysis in it that it makes sense for our business and our borrowers. And so there's no telecom, no B2C, no e-commerce, no VoIP, no consulting, that kind of thing. No security, cybersecurity stuff. We try and keep that out too. That's a little different. And so we track it. This is the median. It was 8.3x at the end of May. It's lower now. We'll update it in June for the new number. But you can see, I remember specifically in January of 2016, this like massive cratering of SaaS valuations, and it's like a blip on this chart. It's pretty wild compared to where we've come. So the range is much wider now, and we also have private transactions that match this timeline, which is nice. So we can update our model. All right, so then that's where we start with. We start with that 8.3x in this case. What we did next was regress or correlate our private transactions against the SEI. A little bit noisy, but generally speaking, a positive correlation here between the SEI with the public market and the multiples at the time. We'll move on. I won't go into like all the detail on the statistics on any of these, but the idea is to share with you the relationships and then how we got to our final answer. So this is the SEI compared to multiples. The next slide shows growth rate, much higher correlation. Obviously, you can see the relationship here is direct and positive, very high correlation there. So growth rate, as we said, drives a lot of your valuation. And related on the next slide is NRR, which is obviously also positive and direct and strong. And those are somewhat related, right? As MRR is a flywheel that powers your growth rate. All right, you munge all those together, and we'll spend a few minutes on this slide because this is the meat of it all. We have come up with a new valuation framework, new valuation model. It's actually a linear formula for any of those of you who are into regression analysis or statistics. We have our sort of standard y-intercept, and then we have coefficients for all these things to apply to the SCI, to the ARR growth rate, NRR growth rate. And they're obviously the biggest coefficient is growth rate. That's the one that drives most of it. And then the other two are similarly related. The key takeaway here is this is still, even though it's like a mathematical formula, there's still a lot of art here. These are small companies, anywhere from say 2 or 3 million up to, I think the largest was something like 75 or 100 million of ARR at the time. I forget what the upper bound is, but still relatively small in the grand scheme of things. So it's still a lot of art. The blue and the green lines here so this chart shows the valuation multiple that was predicted by the model on the x-axis, and the actual, what the company actually was bought for or invested in on the y-axis. And the orange line would be like, they would be the model predicted it perfectly, right? And so the green and the blue lines are plus or minus 1.25 turns of ARR within the modeled result. And so you can see that like 50% of the companies are within 1 turn of ARR of the model, and then a lot of companies are not. So big caveat, this is a starting place, right? This is some math to get you started. And then there's going to be, again, gross margin, customer concentration, like we talked about, your gross retention rate, which isn't even part of the model. What market you're in, your TAM, whether for some of these overvalued based on the model, maybe a private company wanted to buy you for a specific reason and they overpaid, that's great, whatever it may be. So starting place, there's still a lot of art here, but this is some science to start the conversation and come into a process with a number, at least, that you think is a good place to start, and we can go from there, right? And then the last caveat on this is still sort of understanding what the range of data is around this. If you're super small, under 2 million, this will break. Don't recommend you use it. If you're super large, probably also, it will break less, but still probably want to look at different ways to value your company. If you're shrinking, this may not be a great model. If you're growing super fast, probably not a great. So anyway, and if for whatever reason the public market range gets outside of what this was used, then obviously it'll break again. So, but our plan is now we've got this kind of built, and we plan to update it as we get new private transaction data. You're welcome to send it under NDA if you'd like. We'd love to include it as message you'd like in our model. And as we get as the public markets continue to evolve too. I'll stop there. I don't know if you have any comments, Yuman, or we can do, I'm sure people have questions about this. It's relatively new. Like I said, the white paper will come out in a week or two, so look for that.
So Rob, I think this is super impactful, and here's why, right? Like, we're all guessing the impact of the work we do, and you're in CS, and that NRR really matters. Now you can actually plug it into a formula and push it out the side. SCI, the index, you can't control that. That's the market. NRR, you can control, right? As a CS team, you can make that better or worse. And you actually not only affect NRR, like if you actually improve 1%, you also affect ARR. So your place, your improvement actually hits two parts of this equation. So it's super impactful. And maybe, what I'll say here, right, is let's go ahead and go to the next slide. Like, how do you use this? Well, hey, this is how you use it. Now you can talk about, you can speak ROI all day long. All day long, if I get a 1% improvement in NRR with the investments I make, this is what my return will be. And the return is not only on revenue impact, but it's also on valuation impact. So now, for those of you who've never had ROI, impact before, that there's opportunity, but there's also responsibility. And there's also accountability, right? So if you're going to spend, you don't get it. Yeah, it all comes both ways. Actually, hey, can I ask a favor? Hey, Corey, can you get back on and can you ask Rob a couple of questions? I need to do one quick thing. I'll be back in 2 minutes, but there's a lot of good questions. And Corey, if you can come on and actually do that, that'd be fantastic. Is that okay?
Yes. Hello, can you hear me?
Hey, Corey. Yep.
Hi there. Okay, let's see. I'm going to look through. We do have a lot of questions that have come in. I'll just start at the top. So, and if you don't know the answer, that's okay. Do you have any ideas on good comp plans for customer success?
That's going to be a Yuman question.
Okay. I will save that one.
Yeah,
for
I'll
Yuman.
skip that one.
Okay. Let's see.
I like that. I can see these. So I like this one because this is a good question, because usage-based pricing has come up a lot more recently. A lot more companies are employing usage-based. It's also a little bit of a double-edged sword. So the question asks, with retention, do you focus on calculating NRR at these individual revenue models or on a combined basis? We do both, I guess, is the right. I would say whenever we talk to a new company, we want to know the global retention rate. And then if there's, then we want to dive in. We will do our diligence and understand what that is. Is usage-based driving all of that NRR? And actually gross retention is 70%, right? And so that's really important to understand. And you need to understand it too. And that's the double-edged sword with usage, is it can go up fantastically, but it can also go down. And so something to be aware of. The other thing we'll say about usage-based is our long-held tenet is not to penalize your customers for using more of your service, right? You want to encourage them to use more. So I think a good rule of thumb is like 80-20 there. Seat licenses are nice and stable and recurring. You can build your business off of it. It's cash flow you can count on. Usage has got the fun upside. It can be really impactful, but if you can kind of over tilt the wagon a little bit on it too. So answer is all of it, but then also drilling in. And that's the same for like if you sell to SMBs versus enterprise, we might look at both of those things too. Okay, I can keep going, but Yuman's back, so let you guys drive.
Yeah, Corey, what is there a second question you want to ask, and I can follow up after that?
Just this is a quick one. On the valuation slide, what did SCI stand for?
SaaS Capital Index. That's the index of 91 public companies that we munge. That's also that spreadsheet. We update it every month. It's on our website. You can go download it. It's just an Excel spreadsheet that has market cap and revenue on two different sheets, and then we calculate valuation multiple and then pull that together into a median. So it's public, it's free, you can go play with it. I see another one. I can jump in on
right,
another a good one here is on increasing prices this year for inflation. And I would say we have not seen as much of it yet as we thought. You might have some good data on that too.
So you're
But our
saying you
portfolio
haven't seen price increases very much?
Yeah, not yet. I think the conversations are kind of now probably will include it more, but up until now, I'd kind of wait and see. Is it transitory? Magic word, all that.
I don't know. I feel like I'm paying more for software.
Okay.
I will say a couple things. One is, historically, buyers don't expect software costs to go up, right? Everyone sort of expects Moore's law and whatnot to keep it stable. But I do think, what's happening now in the economy gives permission to software companies to raise prices, right? And those don't come along very often. And I think it's, generally kind of a trap to feel like, software is always should be cheaper, because it's not. Now, some of it is competition. Your ability to raise prices is more than just the macro. It's macro competition, your own cost. I think I'm seeing a little bit more. You're right. It's not widespread, but
I recently heard something really interesting on pricing that somebody who makes tires or a manufactured good, right? They are more inclined to increase prices because their gross margins are being eroded. Their cost of goods are increasing. Software, because it's basically free to provision one more seat license, software vendors are reluctant to increase prices because they don't have that extra cost also. I mean, AWS or whatever might be going up too, but and so, yeah, I think what you're hearing from you and I is you have permission. It's worth it, go for it. So.
Yeah, I got this. I'll ask the next one. I think it's interesting. How should I approach NRR and GRR for on-prem or hybrid or SaaS? And should you group all of them or should you segment them? I think it's always so I'll answer this and Rob, maybe you can chime in. So basically you have different delivery models. I think what's really most important is your subscription model, right? So if your on-prem is sort of more historic, where they pay a lot up front for a perpetual license and you sell them maintenance, that's not a subscription model. But a lot of folks are doing on-prem and subscription. And if you do that, I think you should, as a company, sort of think about them in its entirety. But, it's very easy to segment and just say, hey, which are my healthy clients? Because the delivery model can affect SaaS. So I guess the answer is both. But especially if the business model and the pricing model is the same. Rob, what are you seeing?
Yeah, this kind of goes hand in hand with a question earlier about how do you calculate or think about seat license versus usage. Is global is important, but then also you got to dig in. You got to be honest with yourself first and foremost, but then investors are also going to dig in and want to understand that perpetual license on-prem retention. What's that look like versus SaaS, et cetera. So it's important to look at all of them and segment. That's why I started off with these are the two that we could ask in a 20-question survey, but there's a lot more to it.
Okay, now Carolyn asks about OKRs and KPIs. Have we talked about that? No. Okay. Oh, by the way, we should ask a question, okay, about what's going on now. Sorry, we missed that, didn't we? Did we do the survey? All right. All right. Let's do a quick survey. Sorry, I just ran out for a second. So one of the things that Rob and I spoke about was, should we talk about the economy, right? And we decided that we wouldn't really spend a lot of time on the economy because the economy seems like day to day we feel great, and then we feel awful, and now we feel really more awful. But let's ask you a quick question, right? And this is probably, just getting your feeling on how 2022 is doing. So do you expect your company's 2022 retention rates to be better or worse than 2021? Just a reminder, right? Rob's survey has shown that 2021 was a really good year. So we're asking you about this year compared to last year. Do you think it to be better or for worse? Now, I'm going to answer it as well. Okay, so
it wouldn't let me. So host and panelists couldn't.
Oh, I can't vote? No,
Yeah.
Man, I can't vote. All right. Well, Corey, when it's ready, let me know. But basically, the idea is look, I think the unsubtle question here is the macro. Do you think macro is going to have a problem? Because most people would assume it's better, about the same. All right.
Yeah.
Check out the results.
Wow, the results are up. Everyone can see. That's kind of a wash. Well, most actually better is people expect to be better. 40% is better or much better versus 24% is worse or much worse.
Mhm.
That's fantastic. All right.
Yeah, that's great. That's and hopefully that's an indication of the whole year, and just this. We saw this with the pandemic. Is generally, unless folks were focused solely on like hospitality, the SaaS business model is very resilient, right? So most of the time, B2B software is pretty necessary. There's not a lot of fluff there, right? So
Sure.
even in a recession or inflation, there's going to be a need for what most of you are producing, right?
Yeah, Rob, but I bet you we had asked that question in April of 2020, people would have been like, it's going to be worse, right?
Yeah.
It's going to be way worse.
Yeah.
And
it was a little worse.
It was a little worse,
in 2020,
yeah. It was a little worse.
But then the bounce back was pretty amazing. And
Right.
and if folks worked closely with their customers, it was pretty impressive to watch that they kind of were able to glide right over the deep chasm and kind of parlay that into 2021. So it was interesting.
Well, yeah, by the way, if you see the economic and business news, it's just been so negative over the last couple of weeks that it's actually refreshing to see that most people are quite positive about the retention rate year over year. So congratulations, everyone. Let's make it happen.
Yeah.
Yeah. All right. So let's go back and do a couple more questions in the last minutes we have. And I'll go back to the one that Carolyn asked. What OKRs and KPIs do you use to monitor the success of customer success? I can take a shot at that. I won't focus so much on OKRs because, I think there are different ways to, sort of improve CS. So I'll focus on KPIs. So the metrics, a lot of it is sort of what you have to measure. But what I find most people measure on, of course, will be net revenue retention, gross revenue retention, things that we talked about today. Two others that I see happen a lot are either logo retention. So it's not revenue retention, it's like the number of customers you have and then how many you're keeping. So that's logo retention. And then sort of on the way to the retention, right? Because retention happens generally after a cycle. People may also have KPIs around NPS, right? Net Promoter Score. If you have a health score system, maybe, sort of on an improvement in health score. So those are the types of things, that you can use as KPIs on the way to the ultimate, which is really NRR. But, so those numbers, whether it's sort of the endpoint of NRR or the midway point like NPS, are KPIs that I've seen. Rob, have you seen anything interesting?
I think those are all the same. You know better than I do. But that's right. I think depending on your ACV, your target market, logo is more important. I think that's right. I was also responding. Somebody wanted some of the links to the things we were talking about. So I was
okay.
I was trying to multitask, but I don't have too much to add there.
All right, I'm going to take a note. Yeah, Jesse just has a quick question. CS should represent up to 15% of total operating budget. I've seen it up to 15%. I've seen it actually even a little bit more, but right now best practices are anywhere from 5 to 15%, right? And those numbers are pretty wide. Just like sales and marketing is often wide. People will spend very large amounts. CS tends to be fairly 5 to 15% is not that tight, but it sort of hovers around that. So 5 to 15%.
This is a separate study we do is on spending, and we measure it based on percent of revenue. Mm-hmm. And so it's a little bit different than, because some of those companies are burning a lot, right? So 5 to 15 can be a whole different 12%-ish is about across most ACVs and ARRs, 12% of total revenue is the other metric, which actually lines up again because most of our 2/3 of the companies are bootstrapped, so it's about the same as total budget, so not too far off your number.
All right, let's see. Mario asked, and this, Rob, I'm going to ask you, any relevant differences in valuation when comparing US, UK, Canadian companies versus those based in developing markets? Have you done that sort of slice and dice?
We don't do a lot of geographic splitting. No, it's more economic. Anecdotally, I would say we see some great companies globally. We can only lend to for tax and lending law reasons. We can only lend to companies in the US, Canada, and the UK. But there's some great companies in Australia, New Zealand. We've seen a lot more in South America that are really interesting lately. That's a great market. And for what it's worth, I've heard a lot more people hiring there because of time zone coverage. It's kind of the same time zone as North America. So something to keep in mind too.
And I'm sorry, where were you saying that's a good market?
South America.
South America, yeah.
I find I don't have any great data on performance differences between different markets. No.
Lots of people wanting us to talk about comp plans for customer success. It's a little bit outside of the scope here, but maybe I'll answer real quickly. What I've seen is that, generally CSMs have anywhere from 10 to probably in the high end, 25 to 30% of their on target earnings be variable, right? So be variable. So I mean, just to make the math super easy, let's just say that if they hit their goals, a CSM will make 100. Okay. So that means anywhere from 10 to say 30 of that is variable based on, based on goals. Goals could be NRR, NPS, GRR, right? Those are your typical goals. I would try to make it a hard metric. The lower it is, 10%, right? The more they're going to probably act more like, support folks, right? Like they're going to make sure the customers are happy. They're, that's sort of what you'll likely get. The higher it is, the more they're going to act like salespeople, right? So it's what I've seen. I would say it's probably selling around 20%, 15 to 20% is where I see in terms of comp plans, variable versus base. All right. Rob, I'm gonna ask you this question. Is CS part of OpEx or counts towards cost of goods sold?
Great question. Good one. Gold star for that attendee today. That's
Jason, by the way, Rob.
All right, Jason.
Jason. Okay.
This webinar is free for you today. We'll refund your admission. We have seen historically support is in COGS. And again, historically, support was sort of all of CS. And so all of CS was in support or was in COGS because it was just support. Savvy folks, and I don't think there's like any gap. There's no rule on it. And so, if you have, it's a judgment call is the bottom line. If you have a bigger team and you can easily break it up, we think it's better to throw the sales side of your CS group down below the margin, below COGS, and then keep your support folks in COGS. The whole point of the P&L is basically like, what does it cost to deliver the product? Mm-hmm. And so that's going to be your IT infrastructure, your DevOps, and your support team, right? That's what it takes to serve your customers. So that should be in COGS. The sales functions can all be below, and that's sort of more your ongoing OpEx, right? If you have a smaller team, there's three of you, and you kind of all do a little bit of everything, throw it all in COGS, that's fine. So judgment call, but hopefully that gives you enough to chew on.
Yeah, Rob, and I see the same way. I see generally CSMs being, sort of lumped in the sales and marketing pool, support being lumped into COGS. I also see, if you have an implementation team, those also, I've seen those in COGS more often than not. In other words, if you're delivering if it's part of delivering the product, although, if you sort of talk about it, is support really part of delivering the product? I don't know. Anyway, I've seen support and implementation specialists in COGS and the rest in sales and marketing. So best practice. All right. Well, hey, we've come to the end of our time, Rob. Thank you again for being part of this. This is a great annual tradition, and we always have fun doing this. So
good talking to you. Yep.
Anyway, I want to remind everyone on the call is the recording of this webinar, which of course will include the slides, will be sent out within the next 24 hours. At the end of this webcast, you'll see a survey pop up. We'll appreciate if you take a minute before logging off to complete the survey so we get your feedback on today's event. Anyway, thank you for joining us. Have a great day. Thank you, Rob.
Thank you, Yuman. Thank you, Corey. Thanks all.
No more panicking, okay, everybody?
Yeah,
all right, talk to everyone soon. Bye.